So let's take it literally. If you invest in pizza by buying a hot slice today, you gain something very real, short-term satisfaction. But in financial terms, that pizza is a depreciating asset. The second you swallow it, its value disappears. It has no resale market, no compounding power, no residual cash flow. Eating pizza is consumption, not investment. And consumption, however delicious, has never made anyone a tycoon. But what happens if you think differently? Instead of eating the pizza, you decide to buy the pizza shop. Now we're in an entirely new world, the world of productive assets. The ovens, the staff, the lease, the customer base, those are income-generating resources. Every pie sold creates cash flow, which in financial terms is the lifeblood of valuation. You're no longer a consumer, you're a small-scale capitalist. Yet owning one pizza shop does not make you a tycoon either. A single shop is fragile. A bad month of sales, a new competitor down the street, or a food safety scandal could wipe you out. Think of it like owning one small cap stock, volatile, risky, with no guarantee of survival. To reach tycoon status, you need more than ownership. You need scale. Scale is what transforms a neighborhood pizza joint into a national empire. In finance, this is called economies of scale. The principle that the larger your operation, the cheaper it becomes to produce each unit. Here's why. A lone shop pays retail prices for cheese, flour, and tomato sauce. But if you own 50 shops, you negotiate wholesale contracts with suppliers, locking in lower costs per unit. A single store needs to spend heavily on marketing to be noticed. But a chain? It spends once on a national campaign and suddenly the brand resonates everywhere. Scale spreads fixed costs thin, maximizes efficiency, and widens margins. This is why owning 10 shops is not just 10 times better than owning one. It's exponentially better. The financial term is operating leverage. When your costs are spread across a larger base of sales, every incremental dollar of revenue flows straight into profit. That's the rocket fuel of empire building. But economies of scale alone won't crown you a tycoon. To reach that level, you need something more intangible, brand equity. Think about it. Pizza is one of the most universal foods in the world. Flour, tomato, cheese, almost anyone can replicate it. The barriers to entry are low. What prevents your customers from buying the exact same product from your competitor? The answer is brand. Take Domino's, for example. They don't just sell pizza, they sell speed, consistency, and identity. Domino's is not competing with the corner shop on taste, it's competing on reliability. That promise, delivered in 30 minutes or less, became the cornerstone of their brand equity. And brand equity in accounting is recognized as an intangible asset that often outweighs the physical ovens, buildings, and equipment. A tycoon is not someone who owns pizza ovens. A tycoon is someone who owns a brand so powerful that people pay extra just for the name. That's the difference between selling pies at $10 each and commanding a loyal following that will pay $15, $20, even $25 for what is essentially the same ingredients. Now let's talk expansion. If you try to scale with only your own money, you'll quickly hit a wall. Cash is finite, risk is high, and capital-intensive growth is painfully slow. Tycoons understand a trick. Use other people's money. Enter the franchise model. Instead of building every store yourself, you let other entrepreneurs fund the growth. They invest their own capital to open a Domino's, a Pizza Hut, or a Papa John's, while you, as the franchisor, collect royalties and fees. This is financial alchemy. You expand your empire without spending your own cash. Every new franchise adds to your footprint, builds brand recognition, and generates recurring revenue. But the risk and upfront cost fall on someone else. It's a textbook case of asset-light expansion. You own the brand, they own the buildings, and the cash flows to you regardless of whether the store succeeds or struggles. That's how empires scale without collapse. Of course, no modern tycoon stops at franchises. The next stage is financial engineering. This is where pizza ceases to be food and becomes a security traded on capital markets. Imagine you've built a chain of 500 stores. Now you go public. You list shares on the stock exchange, and suddenly investors around the world are buying into your pizza empire. Your wealth explodes not because you sold more pizza, but because investors assigned a higher valuation multiple to your future earnings. This is the difference between cash flow and market capitalization. The former is how much money you earn today. The latter is how much the market believes you'll earn tomorrow. Tycoons live in the gap between those two numbers. Debt also plays a role. Instead of funding expansion with retained earnings, you issue bonds or take out loans, using your predictable franchise royalties as collateral. In finance, this is called leveraging your balance sheet. As long as your growth outpaces your interest payments, debt magnifies your returns. The average person fears debt, the tycoon weaponizes it. But there's a problem. Pizza is made of commodities: wheat, cheese, tomatoes, meat. And commodities fluctuate wildly in price. A drought in Kansas sends wheat prices soaring. A dairy shortage spikes the cost of cheese. For the average pizzeria, these swings can mean ruin. Tycoons, however, don't leave themselves exposed. They use derivatives, futures, and options contracts to hedge against price volatility. If cheese prices rise, their futures contracts pay out, offsetting the cost. If wheat crashes, they've already locked in supply at a predictable price. The result? Stable margins while competitors crumble. This is what separates the casual investor from the tycoon, the ability to turn volatility into strategy. The same forces that punish small shops enrich the empire. Now let's push this even further. Why stop at selling pizza when you can own the entire supply chain? This is vertical integration. Instead of buying cheese from a supplier, you buy the dairy farm. Instead of relying on a packaging company, you own the cardboard factory. Every step of the chain you control means fewer middlemen eating into your margins. Suddenly, you're not just a pizza tycoon, you're a food tycoon. You don't just sell pizza, you dominate the entire infrastructure of pizza production. That's when the game is no longer about slices, it's about systems. So let's return to the original question. If you invest in pizza, do you become a pizza tycoon? If you buy a slice, no, that's consumption. If you buy one shop, maybe, that's ownership. If you scale into a chain, yes, you're on your way. But if you master branding, leverage franchises, engineer capital, hedge commodities, and vertically integrate the supply chain, then yeah, so, you don't just become a tycoon, you become an empire builder. Because here's the paradox. Tycoons don't eat the pizza. They sell it. They don't think about cheese as flavor. They think about cheese as a line item on the commodities exchange. They don't see pizza ovens. They see cash flow machines. To invest in pizza is not to love pizza. It's to transform it into a financial system. And when you master that system, yes, you become a pizza tycoon.